Welcome to Intelligence Gateway.
Hello. Today we are going to study module for a financial analyst, which is for valuation techniques. Introduction to business valuation. Business valuation is the process of determining the economic value of a business or company. It is a crucial aspect of various business activities, such as mergers and acquisitions, selling or buying a business, obtaining financing, estate planning, and litigation. The valuation of a business involves analyzing various factors, both quantitative and qualitative, to arrive at an estimated value. The ultimate goal is to determine the fair market value, which is the price a willing buyer would pay and a willing seller would accept in an open and competitive market. There are several approaches to business valuation, each with its own set of methodologies and assumptions. The three primary approaches commonly used are: market approach. This approach determines the value of a business by comparing it to similar businesses in the marketplace. It involves analyzing recent transactions of comparable companies and applying multiples based on factors like revenue, earnings, or book value. Income approach. This approach focuses on the future income generating potential of the business. It involves estimating the future cash flows or earnings of the business and applying a discount rate to determine the present value of those cash flows. Asset approach. This approach values a business based on its net asset value. It involves determining the fair market value of the company's assets and subtracting its liabilities to arrive at the net asset value. This method is commonly used for asset-intensive businesses. In addition to these approaches, there are various valuation methods and techniques within each approach, such as the discounted cash flow DCF method, price to earnings P/E ratio, market capitalization, comparable transactions analysis, and book value, among others. The choice of approach and method depends on the specific circumstances and characteristics of the business being valued. Business valuation is a complex process that requires a deep understanding of finance, accounting, economics, and industry dynamics. Valuation professionals, such as appraisers, financial analysts, investment bankers, and business brokers, often perform valuations using a combination of quantitative analysis, industry research, and professional judgment. Discounted cash flow DCF analysis. Discounted cash flow DCF analysis is a valuation method used to estimate the value of an investment or business based on its future cash flows. It is widely used in finance and investment decision-making processes. DCF analysis takes into account the time value of money, which recognizes that a dollar received in the future is worth less than a dollar received today, due to factors such as inflation and the opportunity cost of capital. The DCF analysis involves the following key steps: cash flow projections. The first step is to forecast the expected cash flows generated by the investment or business over a specific period. These cash flows typically include operating cash flows, capital expenditures, and any expected changes in working capital. Determine the discount rate. The discount rate, also known as the required rate of return or the cost of capital, reflects the risk associated with the investment. It represents the minimum rate of return an investor would require to justify the investment's risk. The discount rate is influenced by factors such as the company's risk profile, industry dynamics, and the prevailing market conditions. Calculate present value. Each projected cash flow is then discounted back to its present value using the discount rate. The present value is the value of the cash flow today. Taking into account the time value of money, the formula used to calculate the present value is present value equals cash flow / 1 discount rate n. where n represents the number of periods in the future the cash flow is expected to occur. Summing the present values of all. The projected cash flows are summed to determine the total present value of the investment or business. This represents the estimated intrinsic value based on the cash flows and discount rate used in the analysis. Sensitivity analysis. Sensitivity analysis is often conducted to assess the impact of changing key assumptions such as cash flow projections or discount rates on the estimated value. This helps evaluate the robustness of the valuation and understand the potential range of values under different scenarios. DCF analysis has several advantages. It considers the time value of money, provides a comprehensive view of the investment's value, and allows for sensitivity analysis to assess the impact of different factors. However, it also has limitations. It heavily relies on the accuracy of cash flow projections and requires assumptions about future growth rates, discount rates, and terminal values, which can introduce uncertainty and subjectivity into the valuation. DCF analysis is commonly used for valuing businesses, investment projects, real estate, and other long-term assets. It is an important tool in investment decision-making, merger and acquisition transactions, and capital budgeting. However, it should be used in conjunction with other valuation methods and factors to ensure a comprehensive assessment of the investment's value. Comparable company analysis. Comparable company analysis, often referred to as COMPS, is a valuation method used to estimate the value of a company by comparing it to similar companies in the same industry. This approach is based on the assumption that companies with similar characteristics and financial metrics should have similar valuations. The process of performing a COMPS analysis involves the following steps. Selecting comparable companies. The first step is to identify a set of comparable companies that operate in the same industry and have similar business models, size, growth, prospects, and risk profiles as the target company. The selection can be based on factors such as industry classification, revenue size, market capitalization, geographic location, and product or service offerings. Gathering financial data. Once the comparable companies are identified, relevant financial data is collected for each company, including metrics such as revenue, earnings, profit margins, growth rates, and valuation multiples, e.g., price-to-earnings ratio, price-to-sales ratio. Normalizing financial data. It is important to normalize the financial data to ensure comparability among the companies. This involves adjusting for any unique factors or accounting differences that may distort the financial metrics and make them inconsistent across the companies. For example, non-recurring items or what-time events may be excluded. Calculating valuation multiples. Valuation multiples are ratios that relate the market value of a company to a specific financial metric, such as earnings or sales. The most commonly used multiples include price-to-earnings (PRE), price-to-sales (PAS), and enterprise value to EBITDA (EBITDA). The multiples are calculated for each comparable company based on their market prices and financial data, applying multiples to the target company. Once the valuation multiples are calculated for the comparable companies, they are applied to the corresponding financial metrics of the target company. For example, if the average P/E ratio of the comparable companies is 15 and the target company has earnings of $10 million, the estimated value based on this multiple would be $150 million. Making adjustments. Adjustments may be made to the valuation multiples or financial metrics of the comparable companies to account for differences between the target company and the comparable. These adjustments can be subjective and may consider factors such as growth prospects, risk factors, market conditions, or specific company characteristics. Analyzing and interpreting results. The final step involves analyzing the range of values obtained from the company's analysis and interpreting the results. This includes considering the relative valuation of the target company compared to the comparable companies, identifying any outliers or significant differences, and assessing the reasonableness and applicability of the results. Comparable company analysis provides a relative valuation perspective, allowing investors or analysts to benchmark the target company against its peers in the industry. It can help in assessing whether the target company is undervalued or overvalued compared to similar companies and can be a useful tool in investment decision-making. Mergers and acquisitions and financial analysis. However, it is important to consider the limitations of the COMPS analysis, such as differences in company-specific factors, market conditions, and the availability and accuracy of comparable company data. Market multiples valuation. Market multiples valuation, also known as relative valuation, is a method of valuing a company by comparing its financial ratios or multiples to those of similar companies in the market. It is a popular approach in investment analysis and valuation. The key steps involved in market multiples valuation are as follows: selecting comparable companies, similar to the comparable company analysis comes. The first step is to identify a set of comparable companies that operate in the same industry and share similar characteristics such as size, growth prospects, and risk profile. Determining the appropriate multiple. There are various types of multiples that can be used, depending on the specific valuation context and industry. Common market multiples include the price-to-earnings PV ratio, price-to-sales PAS ratio, enterprise value-to-EBITDA, EBITDA ratio, and price-to-book PAB ratio. The selection of the multiple depends on the industry norms, availability of data, and the specific aspects of the company being valued. Gathering financial data for both the target company and the comparable. Calculating the market multiples. The selected multiple is calculated for each comparable company by dividing the market value of the company, e.g., market capitalization, enterprise value, by the corresponding financial metric. For example, the P/E ratio is calculated by dividing the market price per share by the earnings per share. Applying the multiple to the target company. The calculated market multiples of the comparable companies are then applied to the corresponding financial metrics of the target company. This allows for the estimation of the value of the target company based on the average or median multiple derived from the comparable companies. For instance, if the average P/E ratio of the comparable companies is 20 and the target company has earnings of $5 million, the estimated value would be $100 million. Analyzing and interpreting results. The results obtained from market multiples valuation are analyzed and interpreted to assess the value of the target company relative to the market and its peers. Factors such as differences in growth prospects, risk profile, and company-specific characteristics may require adjustments to the multiples or financial metrics. Market multiples valuation provides a quick and straightforward approach to valuing a company by leveraging the market's perception of similar companies. It offers a relative perspective on valuation and is particularly useful when there are readily available and reliable market data for comparable. Valuation of intangible assets and goodwill. Valuation of intangible assets and goodwill can be a complex process due to their unique characteristics and lack of physical presence Intangible assets are non-physical assets that provide value to a company, such as intellectual property, trademarks, patents, copyrights, customer relationships, and brand value. Goodwill, on the other hand, represents the excess of a company's purchase price over the fair value of its net assets. In an acquisition, there are several approaches and methods used to value intangible assets and goodwill. Cost approach. This approach estimates the value of an intangible asset by determining the cost to recreate or replace it. It involves considering the costs incurred to develop or acquire the asset, including research and development expenses, legal fees, and licensing costs. However, the cost. This can include analyzing sales or licensing transactions of comparable intangible assets or companies, market multiples, such as price to sales or price to earnings ratios, can be used to estimate the value based on comparable market data. However, finding truly comparable assets or transactions can be challenging, especially for unique or proprietary intangible assets. Income approach. The income approach is commonly used to value intangible assets and goodwill. It estimates their value based on the expected future economic benefits they generate. The most frequently used method under the income approach is the discounted cash flow DCF analysis, where projected future cash flows attributed to the intangible asset or goodwill are discounted to their present value using an appropriate discount rate. This approach relies on assumptions about future cash flows, growth rates, and the discount rate, and it requires careful assessment and analysis. Relief from royalty method. This method estimates the value of an intangible asset by calculating the cost savings or royalty payments that would be avoided if the company owned the asset. It involves estimating the fair market royalty rate that would be payable to use the intangible asset and then calculating the present value of the future savings and royalty payments. Valuing intangible assets and goodwill often requires the expertise of professionals with knowledge of valuation methodologies, industry dynamics, and accounting standards, appraisers, financial analysts, and valuation specialists use a combination of these approaches and methods, considering the specific circumstances and characteristics of the assets being valued.
Thanks for watching. For more information, like, comment, and subscribe our channel.